Welcome back to yet another recap of last week's news. To end the crazy month of March, we actually had a relatively tame week, so let's enjoy the breather and get right to it. We got some updates on FTX, once the second largest crypto exchange in the world. More specifically, updates on FTX's founder, Sam Bankman-Fried. The U.S. Department of Justice has charged SBF with a criminal count related to bribing Chinese officials. SBF paid the foreign government $40 million in cryptocurrency to unfreeze trading accounts tied to Alameda Research. Remember that Alameda Research was the hedge fund SBF and company fraudulently used to make high-risk trades with FTX's customer deposits. Sam Bankman-Fried was arrested in December of last year and has since been charged with an extensive list of crimes. I knew he was facing general charges of fraud and legal action from the SEC, but I had no idea just how many charges he was hit with. The first indictment was 8 charges related to defrauding customers and investors. The second indictment was an additional 4 charges related to defrauding financial institutions. And this latest indictment was the bribery charge. That's 13 counts of crimes committed. And if I was a betting man, I'd say there's more on the way. The takeaway from the FTX saga is a cautionary tale. Leading up to FTX's collapse, 2 red flags existed. The first, FTX's interest earned on deposits was too good to be true. They were offering up to 8% interest guaranteed on deposits and assets housed on the exchange. For reference, most high-yield savings accounts don't exceed 4% in today's interest rate environment. The only way they could sustainably pay 8% was if they were earning double-digit returns on deployed capital. If you want double-digit returns, you're taking risks, a lot of it. Hence, Alameda Research. The second red flag was the general lack of regulation. The cryptocurrency industry has a tiny fraction of consumer and investor protections in place for other financial assets like stocks and bank deposits. The legal framework around crypto is still in its infancy, and most of our regulating bodies are even struggling to define what crypto is. And furthermore, whose jurisdiction it falls under. There's very limited oversight that can identify both the risky and fraudulent actions of companies like FTX. If a regulated institution like Silicon Valley Bank can go under, it should be no surprise that Sam Bankman-Fried was able to do what he did. Alibaba, the Chinese multinational tech firm, is going through a monumental reorganization. It was announced the company would be split into 6 separate business entities in an effort to stimulate growth. The 6 groups will be organized around Alibaba's core business activities, such as cloud computing, e-commerce, and streaming. What's interesting is that Alibaba will continue to oversee each entity, but will allow them to be run by their own CEO and board of directors, while seeking their own financing. In fact, it's intended that each business group will go through an IPO to raise capital to fund their growth initiatives. The Alibaba organization comes with some questions about the motivation behind the move. Yes, the firm has officially stated it was all in the name of staying competitive following a period of stagnant growth, but there's a lingering sense that this wasn't Alibaba's idea at all. Remember that the Chinese government openly campaigned against the growing influence of Chinese big tech through a series of antitrust actions, which resulted in what many believed to be an unofficial exile of Alibaba's founder, Jack Ma. So, with that said, could it be that the Chinese government forced Alibaba to reorganize? By doing so, they would essentially decentralize both Alibaba's resources and market share. Perhaps it's a little far-fetched with limited evidence, but it wouldn't be the first time the Chinese government dictated private enterprise. After all, it was stricter Chinese regulations that resulted in the fintech company Ant Group suspending their IPO. This certainly highlights some of the risks involved with investing in foreign markets. It's not that other countries are inherently more risky, but more so about the differences in geopolitical factors. There are excellent companies outside of the US that have been allowed to thrive in their respective regions with the support of their governing bodies. But throw in factors like war and authoritarian governments, and you have an environment that isn't conducive for enterprise. So, if you're interested in investing in foreign markets, I wouldn't concentrate on one particular region. Similar to how you would diversify across US industries, diversifying across several countries can mitigate those geopolitical risks. Artificial intelligence is quickly becoming a main storyline for the year. Last week we talked about how OpenAI released their new model, GPT-4. And at the end of it, I expressed that we shouldn't fear AI, at least not yet. But there's several industry leaders that believe otherwise. In an open letter, well-known figures like Elon Musk and Steve Wozniak endorsed a call to suspend the experimentation of AI technology. The reasoning behind it is to slow the already exponential rate of AI development and give regulatory bodies an opportunity to put safety measures in place. Reading an excerpt from the letter, contemporary AI systems are now becoming human competitive at general tasks, and we must ask ourselves, should we let machines flood our information channels with propaganda and untruth? Should we automate away all the jobs, including the fulfilling ones? Should we develop non-human minds that might eventually outnumber, outsmart, obsolete, and replace us? Should we risk loss of control of our civilization? Such decisions must not be delegated to unelected tech leaders. Powerful AI systems should be developed only once we are confident that their effects will be positive and their risks will be manageable. Even though I don't agree that the initial phases of AI will be as destructive as others believe, I understand the mounting concerns about the rate at which AI is advancing. The thing about innovation, whether that be technological or financial, is that it always seems to outpace regulation. We often see more resources and more efforts piled into the innovation side of things because the fact of the matter is, innovation is more profitable than regulation. So if regulation is constantly trying to catch up, maybe this hiatus in development is what's needed. Maybe something like this is what was needed in the crypto space. Sometimes you just have to choose protections over profits. In other news, cars are still ridiculously expensive. That's all I have to say about that. But really, it looks like car manufacturers and dealers will try to keep car prices elevated for as long as they can. In a recent interview, Toyota's head of sales in North America said he sees the average price of new cars exceeding $50,000. He cites consistently high demand and continued supply constraints as the factors driving prices up. But that begs the question, how long until demand levels take a dip? As of right now, auto loans are becoming less and less affordable as the Fed's rate hikes bleed into the consumer credit markets. And these interest rates are locking car buyers into high monthly payments. The average used car payment is $526, and the average new car payment is a whopping $716. Those looking to purchase a vehicle may think twice given those financing terms. Add that to the general uncertainty around a coming recession, and you have potential buyers opting to wait for prices to come down, or opting to find more cost-effective alternatives. From someone who's in the market for a vehicle, I can definitely say current prices are deterring me from making a purchase. It's just hard to see the value added when these types of vehicles would be sold for several $1,000s less under normal market conditions. With that said, I have noticed a buildup of inventory at dealerships around me, so I suppose that's a little anecdotal evidence that demand is finally falling. And that's all I have for today's video. If there was any news you'd like to discuss, I welcome you to drop it in the comments to get that discussion started. As always, thanks for watching. Until next time, take care of yourself and best of luck.